All right, I'm Michael Hartzman. Today is Tuesday, March 9th, 2026. And I'm on as always with my partner Dominic Tavella in a both on Long Island and both enjoying a beautiful day in New York City and Long Island.
Yeah, very pleasantly surprised not to have 3 feet of snow, Mike. So I am scheduled to head south, but grateful to have the weather we're having right now.
Yeah, I think the blizzard was 2 weeks ago. I lost track already, but it's gone. All the snow is gone, and they say March comes in like a lining out like a lamb. So here we are, March 9th, and hopefully we are officially done with the snow.
Hope so.
So moving on, the I just want to jump into this real quick, Dom, because we have a great guest tonight, Michael Legabo, who we've had on before, affectionately known among his counterparts as Macro Mike Legabo. He's a global market strategist at New York Life. He was booked months ago. Perfect timing to have a global market strategist on. But also, Dom, last week you and I and a few of our team members got to go to Goldman Sachs's world headquarters, and and we're so fortunate when we get to hear just context and logic and really smart people who history doesn't repeat itself, but there's certainly a pattern to when these world events happen. And just to get Goldman's perspective last week from their economists, and to hear when they go back to literally global events like this since 1986 and could chart these things and tell us 90% of the time the S&P is higher 8 weeks later. Now, look, of course, that's anecdotal. There's no guarantee it'll be that way this year, this time. But we hear evidence like that. We hear evidence that, the global need for oil for this country has gone down significantly since 1973. Just so much evidence that everything will be fine. You and I often are told how calm we are. And I think the reason we're so calm is because we get access to really good information, really logical information, and it's our job to pass that along and to have a steady hand. So we got that opportunity last week. We're going to get it again tonight. And I just feel super grateful that we get access to information that, quite frankly, a lot of financial advisors just don't get to be in the room.
Yeah, look, gratitude. You're absolutely correct, Mike. We often get to sit in a room with what I love to say are the smartest people in the room. Um, and not only do they have decades of experience and wisdom, but frankly, Mike, so do you and me. We're both in the celebrating 40 years in the industry. And I hate to say we've seen this before, and God forbid, but I'm sure we'll see it again. And we know normally how these things work out. So just looking at the TV, just looking at the news every night, just looking at the headlines can be very, very frightening, right? Which is why we sent out that email a week ago, because we knew Monday was going to be rough. When you're talking about potentially a bottleneck where 20% of the world oil supplies can't get out, it's going to have significant geopolitical, geoeconomic ramifications. And we knew it would be bad. But we also know, like the snowstorm, eventually the sun does come out. Eventually things get better. We just have to be able to ride out the storm. So for you and I to sit in a room at Goldman and have this terrific gentleman with us tonight who's been our guest before, and many, many other conference rooms that we've sat in, to have the wisdom, the knowledge, the experience that we're able to then use in our client portfolios is truly, truly a blessing. But I'm also going to give a little credit to you and me. We've been down this road before. We know how the game goes. We know how eventually, hopefully, it will end. And that means don't make any dumb moves. Don't panic. It'll hopefully, but it'll all work out in the end.
Absolutely. And I was looking at one other slide that you remembered this morning when we were talking. I can't find it exactly, but I'm pretty sure I'm right that a $10 increase in oil per barrel reflects 1/10 of 1% to gross domestic product.
And that's even more important, Mike. Not only our growth in this country, but on the planet. We're talking about the entire economic output of the entire planet. It would have 1/10 of 1% potentially negative growth on the global economy.
Yeah. And look, you and I are not minimizing that this is a terrible thing and people are dying and people putting their lives at risk. All that's awful. And that's what CNN and Fox News to freak people out about. That's not our job. Our job is to really look at it more from an economic point of view, and that's the context we're bringing to our clients and our listeners.
So the two big fears, obviously, the cost of energy and what's it going to do to the global economy. And the second one, Mike, is this idea that it potentially could really spike up inflation. And again, we got some really good data on that point.
Yeah, yeah, and look, it is like the snow, right? Because Sunday night I'm relaxing, reading a nice spy novel, and I get an alert that oil is $120 a barrel, and the futures for Monday morning are down over 1,000 points. And what happened to the stock market yesterday afternoon?
Well, so we saw that big whoosh down in the morning, and that means people were selling. Right now, I don't know who was selling, but by the afternoon, they probably regretted selling, right, Mike? Because we had a big rally up in the afternoon, and I think two of the three, I could be wrong on this one, Mike, but I think two of the three of the major indices ended the day higher. So if you were a big seller first thing in the morning, you probably regretted it by the afternoon.
Yeah. And again, just some perspective through Friday. We always do the numbers when we open the show. Through Friday, which was March 6th, I believe, before the little rebound on Monday, um, the S&P 500 was down 1.3%. The Dow Jones was down less than 1% at 0.86. And the Nasdaq was the biggest loser here domestically, down 3.58. Year to date, the MSCI EFA index was still up 2.7. The emerging market index was still up almost 7%. So, yes, it's been a bumpy road, but Dom, the wheels have not fallen off as of yet.
Yeah, Mike, honestly, I was waiting for you to bring that up, right? So if you look at the headlines, if you're looking at the news every night, and there are a lot of innocent people dying, and obviously our hearts break for those people, and especially our own American soldiers that were killed in action. Having said that, yeah, we're off the highs for the year, right? We're negative, but when you think about what the headline risk is, when you think about this oil basically being shuttered inside and can't get out of the Straits of Hormuz, for the S&P to be down a whopping less than 2% is absolutely remarkable because we get it all the time, right? My clients call up and like, oh my God, I don't even want to look at the numbers. Oh my God, I'm scared to look. How bad is it? And when we tell them that, they're just genuinely surprised.
Yeah.
Based on the news, they expect a lot worse. And I guess at least for now, thank God, the numbers really aren't bad at all.
No, they're not. And again, just two other points I was thinking about. One came up this morning on our call with our advisors. Last week was the 17th anniversary of the S&P 500 hitting bottom from the financial crisis, which started in September. Obviously, we didn't know then it hit bottom, but history tells us it did. So the S&P on March 6th in 2009 hit 666, which is kind of a spooky number in and of itself.
Yep.
Right now, the S&P 500 is up 10 times that, 6,740. Furthermore, we are coming up on the 6th-year anniversary of the lockdown and the pandemic, an event that I would argue no one had previously lived through when it started 6 years ago. And the market has been on a nice little tear since then as well. So, as I said, history doesn't always repeat itself. A lot of these things are anecdotal, but history does have a pattern.
Yeah, and Mike, the COVID crisis clearly left us all a little scarred, right? But I remember that event when the market, the S&P hit 666, and it truly, truly felt like the end of the world. It was the most catastrophic. I mean, I was around in 1987, and this one felt a lot worse than that. And yet, sanity came back into the equation. Companies figured out how to not only survive but grow. And as a result of economic activity and growth, companies just don't go up to the stars for no reason at all, at least not most of the time. So it's about economic growth, it's about earnings, about dividends, things like that. And the fundamentals have justified today an S&P that basically, as you said, is 10 times what it was worth back then. So patience, a little fortitude, taking it a little bit in stride. It does work out. At least it has so far.
At least it has so far. So listen, we have Macro Mike Legabo patiently waiting on the sidelines to kind of jump into this conversation. I think we've given him a lot of fodder to chew on and to follow up on the conversation. So we'll be right back with Mike Legabo, global market strategist at New York Life, and he'll be with us for the rest of the show. All right, I'm Michael Hartzman, back with my partner Dominic Tavella, and our very special guest this evening, and a returning guest, Michael Legabo, global market strategist at New York Life. How are you, Michael?
I'm good. I'm good. It's great to be back talking with you guys. A lot to talk about.
There is, and
Lots to
let's just
talk
kind of
about.
jump into it. I know you were listening to the open, and I know you just mentioned that you obviously at New York Life have your own perspective, got your own letter out to your clients. So you kind of echoing some of the context that Dom and I were talking about? You guys have a different perspective on it. Where are you guys at this moment?
Yeah, absolutely. I'll frame the macro backdrop first, then we could talk about that market reaction you mentioned. So real quick, stepping back, I think the easiest way to frame the macro backdrop right now in our view is that the cycle is still extending, but it's extending in a much messier way. On one hand, the growth backdrop, up until the attack and even still, is reasonably resilient. Household balance sheets in good shape, corporate profitability, corporate balance sheets on good shape. On the other hand, last Friday's February jobs report reminded us the labor market is still pretty fragile, and that fragility is really colliding with now this, big geopolitical backdrop. So the key to is like we really think that the markets are trading a lot of backdrops or a lot of backgrounds. They're not just trading the growth environment. They got to trade the political environment. They got to trade geopolitics. So it's a lot of sources of uncertainty, a lot of sources of volatility. So I think a lot of the questions we're getting is how to manage that. And yeah, obviously. The strikes, and now we're calling it an excursion in Iran, has been pretty severe on markets. And I think one point I want to come back to is that the market reaction. The S&P down 2% that day. Maybe it's a few percent off its highs still, and it's been kind of chugging along range bound for a few months now. But I do think that's kind of interesting. I think if you look in the past, and maybe the market has become too complacent with geopolitical event risks, right? In the past, the markets would sell off drastically at these events. Now everybody knows they're a buy opportunity, right? And everyone's already kind of in this buy the dip mentality. So in the past, maybe a big doom and gloom event would happen like this, and really there's only like a 10% chance that the global economy heads into a severe recession. But the market looks at it like there's a 50-50 chance. So you could probably get some good upside convexity, if you say, the market's pricing this wrong. I don't think it's that bad. I think we're in the opposite case these days. Now the market sees some geopolitical event. It's like, let's buy, versus, hey, let's reassess. If this turns out to be a longer thing, our oil prices, our yields, is the market really reflecting kind of an extended kind of military excursion? So yeah, it's been kind of interesting to see the market react so resilient in the face of, what could be as you guys were talking about, what could cause a global recession.
Michael, I'll stay focused on that point for a second. I'm genuinely surprised. I mean, I think a 5 to 10% pullback would have been quite normal. I mean,
Hmm.
this potentially could be a very significant geoeconomic event, right? And yet, you're a little surprised the markets are kind of taking it in stride. I mean, maybe the S&P was up 2.5%.
Hmm.
Now we're down maybe two. So I don't think it's been even a 5% pullback at this point.
Yeah, I mean, extremely well, like I think taking it in stride extremely well, as you said. I think there's a couple things going on. One is there's that Trump taco trade, right? It's the taco Trump always chickens out. That was, and have we seen some of that happen already? Maybe, but we knew there would be we're saying, like, what market indicators would constrain Trump, and around Liberation Day, that's the market sold off a good 20%, and that kind of led him to pull back a little bit there. Same thing here. We thought, okay, if the market goes down, or if oil hits $100 a barrel, you'll see some kind of slowdown. And that's kind of what we're seeing. I mean, West Texas crude hit 120, yesterday. That's wild. That is significant. That's a significant risk for just the U.S. and global economy. So yeah, the markets took that well in stride, but I think they also see that as, Trump likes the stock market to go up, and if something's going to bring it down, maybe he'll pivot. And honestly, I think because of the kind of the relatively unclear goals, unclear timelines currently kind of in the news, in the narrative, in the market narrative, that, just saying today or yesterday, we won, it's over, is enough to kind of calm markets. And like he had that opportunity to kind of do that. So, and it's, brought crude back to 86, but still pretty steep. So yeah, taking it in stride for now. It's definitely pricing in the market's definitely pricing in the rosiest outcome, the shortest outcome in this scenario. So it's just, now we'll have to see what happens.
But there's a lot of validity to what you just said. And Dom and I always we say it every week. We're not a political show, but every now and again we just can't help it. And I always question in the last 2 weeks the timing of all this, because if the Republicans go into the summer with gasoline at $4 a gallon, next thing you know, you blink it's Thanksgiving. Just the timing always seemed bewildering unless either, they knew this was going to be short, or as you said, he was going to announce that it's going to be short
Hmm.
because I think it'll be political suicide for them to go into driving season and vacation season with oil at $4 and gasoline, I'm sorry, at $4 a gallon.
Yeah, yeah, that's a huge gamble, and I'm sure that's going to show up in the midterms. I think it's all the pundits and the vote counters seem pretty certain that Republicans will lose the House, but they'll keep the Senate. That's pretty much like everyone's base case right now. If the affordability crisis really gets out of hand, then maybe the Senate is in play as well. But yeah, certainly, I think like it's a big gamble, right? I think they gambled. He was hoping it would be a quick Venezuela-like operation, in and out, but. Yeah, that'll certainly, people are certainly going to be feeling that. Um, it doesn't impact the US as much now that we're like a net energy producer. But of course, it still shows up at the pump because it's a globally traded commodity. One option I didn't read about today, we could, something we could kind of talk more about is like kind of the rationale and stuff behind this. But, one option that the US could do, which is a very grave option, not likely to happen, the US could say, okay, we're not going to export any oil. And if we stop sending people oil, then I think, resource nationalization, I think, becomes a much bigger risk if the U.S., kind of turns that spigot off. Um, so yeah, I think it's for the U.S. economy, like we said, we've been more insulated as a whole, headline growth. But you're right, the um, most people are going to be feeling it. We've written a lot about the K-shaped economy, and the bottom of the K really, because the top of the K drives the economy, but the bottom of the K votes too. And the bottom of the K, they'll be feeling these gas prices. They're already in an affordability crisis, and yeah, this is going to strain it even more. So yeah, you could imagine that some stuff like this will come up. Um, Later in October. So we also kind of think about in November. We also kind of think about what other levers could they pull. He's talked about, tariff checks, tariff rebate checks, more checks to the military, just other fiscal supports that we could use, I think, to like, ease the affordability crisis. But any president, any politician has a little grasp over true affordability like that. And then just to kind of finish this conversation on the U.S. Strategic Petroleum Reserve, we could draw that down, but it's already pretty low. They probably should have been filling it up already, and it's already pretty low. So it's not like we have a lot of supply, a lot of supply there.
So, because we are pretty much net energy exporters, we have plenty. So I
Hmm.
would think the overall economic effect would hopefully be minimal. But you look at what international markets did last week. The MCI was down 6.72%. Emerging markets were down 6.88. So let's round it off and say both were down about 7%
Hmm.
last week alone. And they've been on fire for quite a while. Clearly, overseas economies are way more dependent than
Yep.
US economies. You
Hmm.
want to spend a moment on what these economies are looking at?
Yeah, certainly. I mean, the European economy is much more exposed to energy prices, especially gas prices, and both like Qatar, all those countries are have temporarily paused all their exports. So prices are going up across the energy spectrum. And yeah, we've saw that reflected in market behavior and leadership too. These non-US markets, non-US developed markets in that EVA index were eating the S&P 500's lunch, since the beginning of this year, since the end of last year. But now, obviously, that trade seems to be reversing now, and like yeah, I think could be some flight to quality as well. And it's not just the dollar treasuries, it's also US assets. So I think there's yeah, so that kind of that rotation I don't want to say there was a full rotation out of U.S. assets, but that rebalancing towards non-U.S. assets seems to have reversed, of course, but like we said, because like everybody, most countries are energy importers, um, and that's really going to weigh on them.
Michael, staying on in the global theater, every time I get to sit with someone like you lately, I ask them about China.
Hmm.
Because to me, China has been unbelievably quiet since we invaded Venezuela and basically affected their supply of oil from Venezuela, which they were a huge customer of. They were a huge buyer of oil in Iran. At a certain point, do you worry that China has something up their sleeve or some economic retaliatory scheme, that they could potentially head towards us?
That's good. That's a good question. I know these countries are always jockeying with each other. I'm sure they're spying on us as much as we're spying on them. Um, no, from militarily, I'm definitely not worried about China in that regard. More economically, is there something they could do? They've been. I don't think I'm trying to think if there anything, any like immediate lever they could pull. They're continuing to diversify away from the U.S. And I mean, honestly, the truth is, if they really wanted to invade Taiwan, this would actually could be a good opportunity because of all of our assets are in the Middle East. Um, However, I think it's been pretty interesting. The Venezuela, I'm surprised they haven't really pushed back on all of that. They are in terms of Iran, they are pretty much regime agnostic. So as long as they can get their energy out and buy it, then they don't care who's running the country. Um, and I definitely agree with your point. I think a lot of people were kind of uh, asking, what's the purpose of this? What's the rationale behind this Operation Epic Fury? And I think you nailed it. I think that's what my note was about. I think it's all about China. Venezuela's been about China. Um, Iran, has its own issues, but it's still really about China. And I point to in the framework I use here is the new U.S. national security strategy that was published in November of last year. I've read it. It's a 33-page document. It's easy to read. I've read it a few times. And it really lays out a framework for how this administration is approaching foreign policy. And it's a vastly major change from what we've been, from the rules-based order, as a term that likes to get thrown around. Um, that we've seen. And I know that I have a lot of liberal friends and I have a lot of conservative friends. And they're always jockeying. And I tell my liberal friends, they're unhappy what's happening. I say, well, the truth is uh, you know, at least this administration, they write down what they're going to do, and you may not like it, but that's what they go and do, right? So I use this, you can use this document, I use this as my framework, and they say very explicitly, we can't tend to all regions of the world. We need to prioritize. China is our main focus. We're going to try and allocate resources towards China, and that means in order to we need to compete with China on all fronts, including energy front, and we need to remove, and that kind of implies they need to remove China's energy sanctions resistant energy foes, and that comes from majorly Venezuela and Iran. Um, Definitely, I think this is kind of like um, falling into that kind of dynamic. We talk about a lot about in our geopolitical kind of work. We point to that we're part of that this is all part of this kind of global regime change that we're undergoing. We call it the end of the US-led world order and the rise of great power politics. Some people call it the end of the unipolar moment and that we're back to multipolarity. Political economists would say the neoliberal era is dead and the neo-mercantilist era is starting. Whatever you want to call it, these trends, these resource nationalism, economic nationalism, trade, tariffs, trade, more aggressive kind of global posturing is the new norm. And we're now seeing that being written directly into official policy documents and then being acted upon. So yeah, I do think this is a way for the U.S. to kind of like, in order for the U.S. to deleverage risk from the Middle East, it needs to address the Iran regime. And if they can do that, that's kind of what this was about. Why today? Why this week versus next month or 2 months ago? maybe they just had their shot. But that's I do think it's they're really trying to kind of kneecap China here. Um, but like I
Mike,
said,
I
yeah.
want to interrupt you because
Hmm. Hmm.
that's an incredibly, I think, valid point, and one that doesn't seem to get a lot of press. But you are correct. They basically cut off oil shipments out of Venezuela. They've cut off the dark fleet coming out of
Hmm.
Russia to China. They've cut off Iran oil energy to China. I mean, they cut off the Panama
Hmm.
Canal, where you had Chinese companies controlling both entrance and exit of the canal. I mean, they have been like a chess match, piece after piece after piece, very deliberately, basically, I don't want to say cutting off China, but making sure China stays within certain parameters,
Hmm.
certain level of control on a global scale.
Yeah, certainly. I mean, China, that one their Belt and Road initiative, they really have their hands in a lot of different ports. They own ports in Peru. They own a lot of other strategic assets, and it's not a lot of these places you can't park military assets there. But again, it does give them kind of a big strategic influence in these regions. And the other one of the other takeaways from that national security strategy that it really emphasizes hemispheric primacy, right? We want to be the leader in our hemisphere. If you're mining for resources, if you're exporting things in our hemisphere, the US has to okay it, right? And now China, and so we're basically saying, China, we're not going to, in some ways, we'll say we're not going to, bother you too much with what you're doing, but stay out of the Western Hemisphere. And that's really, yeah, 100% right. So they got them out of Venezuela, Panama as well a little bit, but it's still going to be tough. I think they're still well ingrained, but it's more kind of rhetoric here and where the growth goes. But yeah, certainly the U.S. is saying, this is our turf. Do what you want in your turf.
Mike, let's take a break right there. And when we come back, there are other parts of the economy that still matter, interest rates, inflation, the Federal Reserve. So why don't we take a break here and talk about some other things that could affect the economy in the world when we come back? So we'll be right back with Mike Legabo, global market strategist at New York Life. All right, I'm Michael Hartzman, back with my partner Dominic Tavella and our guest this evening, Michael Legabo, aka Macro Mike, global market strategist at New York Life. So, Michael, we spent the first half of the show talking about Iran. There's other factors that always affect our economy and the global economy. The big one is we're going to have a new Fed chief in, I guess, a couple of weeks now, assuming he gets confirmed. Trump has made it crystal clear he wants lower interest rates. There's a lot of cross currents now. If the price of oil and gas, I keep saying oil, the price of gasoline is $4 a gallon. That's clearly inflationary. Um, all the people we speak to, I think New York Life's in the same camp. And we spoke to you guys a couple of weeks ago in Manhattan. Two interest rate cuts this week. How
this year.
has, I'm sorry, this year, I apologize. Thanks, guys. Has that, any of that calculus changed with what's going on with Iran, or you guys still expecting, at least two cuts this year and expecting Kevin Walsh to be confirmed?
I think, yeah, we do expect him to get confirmed if they. I think that there is that one, he has to get out of committee, and there's a senator on the committee that is right. Is it Massey?
Yes.
Okay, and he won't approve anybody until the case
Until
against
Trump stops trying to throw Jerome Powell in jail.
until yeah until the whole Fed until he stops trying to
I'm,
I think
throw
I'm
Kevin
just
on the
calling it
Fed
a spade a
committee.
no,
spade, Michael.
I know. No, we believe in the Fed over here. No, I think Kevin Warsh is a good pick. He's not, doesn't see, he's a true economist. He knows the markets. He doesn't seem like a political hack here. So he should, assuming Massey approves, like easily, get the nomination. Um, it seems like Jerome Powell definitely is. I don't think he'll make any more moves this year until his term is up, and then Warsh can kind of come in and give and cut once or twice in the back end of the year, and kind of kick his term off like that. In terms of, you know, I kind of think in terms of like let's just talk market pricing first. So when the oil started going up, the market was pricing in the first rate cut at the June or July meetings, and now it's been pushed to September, which kind of makes sense. I think maybe Porsche comes in if energy prices are still high, and he waits a couple months, and then um, and then kicks off, with his first cut. Yeah, so we still think 1 to 2 in the back half of the year. That's what the market is pricing as well. Obviously, yeah, gas and energy prices. The Fed typically can look through one-time price hikes with tariffs, with oil spikes as well. So it doesn't. It's only until how long the price hike is sustained, such that these second order effects start working their way into higher prices for goods and services. Obviously, I think most people, they see price of gas go up, the price of, gas at the pump. I think, okay, well, it's gonna cost me more to fill my tank, but it's also gonna cost more to drive the groceries, across, ship truck the groceries from the plant to the market, right? And that's gonna be higher prices. Same thing. So along those lines, we expect to see. So it's really like how long that kind of that duration lasts. Kevin Morris, he seems okay. I've seen him speak a few times. He has some. I'd be interested to see, how he changes the Fed. One thing he said, that one thing he said that really stuck in my mind is, he doesn't believe the Fed. He believes kind of that the Fed has power, but they're very strong, but it's not. They have more of a bulldozer than a screwdriver, right? In terms of like moving the economy. If that's the right analogy. They have more of a hammer than kind of a more finely tuned instrument. Um, and so one thing he believes is he says, the Fed should live on the left side of the decimal point, which I always thought was very interesting. It's like the Fed should not be trying to predict inflation at 2.3 or 2.4 or 2.35%. That's not what the Fed is for. Um, he also kind of has mentioned that, maybe the Fed is too transparent. Maybe the Fed speaks too much. So could we see kind of a dialing down of, Fed projections and the dot plot, or even press conferences? Because before the GFC, before the Great Financial Crisis, those that press conference, I think, was was less common or just never happened. Um, One thing, the Fed now when the Fed has a meeting, they're on the front page of the news. But he said 20 years ago, 30 years ago, even when the Fed made a change to the rates, they're still on page 15. And he's like, I'd like to see the Fed kind of move back in that direction. So it is kind of interesting. We'll see if he kind of changes some things around. But in terms of cuts, he seems to be, you know, I think he's willing to kind of cut rates. Um, and I really think you only need, it's really kind of like where our neutral rate is now. And that's the big debate at the Fed. I think one or two will get you there. So yeah, I think he'll have some room. He may have some room to cut in the back half of the year, um, especially if the Fed kind of looks through this as like a single kind of price hike, price move, spike.
So, Michael, it seems like there's a refocus now more from the Fed on the employment data. We got a
Hmm.
pretty ugly number on Friday. Now, maybe it was the nurses' strike in California, maybe it was the weather, but
Hmm.
it still was not a good number. Is that kind of a leading indicator that maybe the employment scenario, forget about getting rosy, but might be deteriorating?
Yeah, certainly. Even if a lot of the labor scenario we've seen has to do with kind of the immigration and the deportation impacts that we've been seeing, that's fine. Even if you take those out and you just kind of look at a trend of monthly payrolls added or lost each month, for the last 2 years, you can see kind of a consistent downtrend. So it's not um, it wasn't. So we do know, we did see that the market, that like the fragility in the labor market was building. The miss here from like expected 55,000 jobs to an actual down 92,000 was a big miss. So yeah, I think and you already mentioned kind of the factors distorting it, like the strike and whatnot. But when typically when we see a couple negative prints, negative jobs prints, that's when recessions begin. So I don't think we're there yet, and I do think where it may not be as indicative this time because the break-even level of jobs, given the kind of the stagnant labor force size, because we're not taking anybody in, does kind of distort the numbers a little bit. You know, if you had a 50,000 print jobs print a few years ago, that wouldn't look great. But now, the break even number is probably closer to 50,000. So hitting that number is kind of not inflationary or disinflationary. But I do think, yeah, if we get another bad print, it's certainly going to welcome more Fed cuts, maybe sooner. But when it comes to the job stuff, it's especially because of the K-shaped economy. Um, you know, bad news on the jobs front is typically good news in markets, right? I mean, if the market starts to price in more Fed cuts on bad jobs data, capital markets are going to improve. Labor market kind of weakening isn't good for a lot of people, but for capital holders, Fed cuts are helpful. The other thing we've been thinking about on labor, I'll let you come, are these labor job losses due to AI and increase in productivity there? Um, Not yet. Maybe some. It's hard to really attribute some of these job losses to AI. We knew, some companies are making headlines with their changes, but we don't really think it's showing up in the headline numbers in productivity and in like jobs gained yet. So we don't really think AI is a force here, but keeping our eye on those labor that labor market because the last thing here, our economy is driven by consumer spending. What drives consumer spending? Or what changes behavior in consumer spending, what causes people to tighten their budgets is if they see people in their social or professional networks lose their job. If they lose their job, or if they see people, their friends and family lose their jobs, that's when they start to pull back on spending. So if we see more of that, consumer spending comes down, growth comes down at the high end. So yeah, we're definitely kind of like following that transmission mechanism. But yeah, the fragility pretty widespread on that jobs report. Not just healthcare, but you know, still waiting for that manufacturing renaissance. Those jobs have been pretty weak too.
Michael, you mentioned the K-shaped economy, which basically means I think the economy just kind of has been split in half. If you literally picture the letter K, and unfortunately, the people who struggle are on the bottom part of that K. You mentioned consumer spending; it's behavioral and psychological, and kind of that was my question. The When gasoline, goes over $4 a gallon, even people who could afford to fill up the gas tank, are offended. They're upset.
Hmm.
They're
Hmm.
pissed off. My favorite story is Dom he told the story back in 2022. He had a wealthy client who had, several $1 million with us, called Dom up and said, I don't need the money I asked for. I'm canceling my family vacation. I'm not driving. I'm not driving across the country. I'm not paying these gas prices.
Hmm.
Remember, Dom said, you could afford to. Because I'm not going to. You remember that, Dom?
Oh, yeah.
All right.
There's no
So,
question he could afford to,
but he
meaning
wasn't
his
going
budget
to.
was way beneficial, but he just refused to literally drive up to the pump.
Yeah. So kind of that's my point, right? This $100 a barrel, 120, $4, it could cost $100 to fill up your tank. Whether you could afford it or not, I think it's a barrier that people of every economic stratosphere is mindful of.
Yeah. Yeah. 100%. I think we'll see. I think in terms of levels, it's really hard for the equity market to kind of, if we're just talking equities, not talking real money here, but if we're just talking equities, it's hard for really earnings growth really slows down with oil over $90 a barrel. And then of course with it over $100 a barrel, you really see it starting to seep into other indicators like services and like consumer spending. Um, but yeah, I mean it's very um, energy, no matter what, is still very inelastic. So people are always going to pay for it, and if they're paying for that, then they're not paying for something else. So yeah, we've seen that. That's kind of what a lot of the charts show is that people still will fill up their car as much as they can, but they'll pull back elsewhere because it really does have like a pretty significant correlation on kind of their disposable income.
Mike, Michael, so I get the right person here. Um, the latest consumer spending number I saw, which I'm sure did not include any data from this past week with higher oil prices, but that consumer spending was actually pretty good.
Hmm.
Whether it was restaurant spending, vacation spending, I think the only category that was down was furniture, but otherwise every other category was actually up. And again, does that surprise you, or this is just Americans that can't help themselves? They're going to spend no matter what.
Yeah, it's a lot of people are spending. It's really the truth is it's the top of the K that's spending. Bottom of the K is struggling. They've been struggling. They will continue to struggle under higher energy prices. The top of the K, older people, obviously more affluent people, they drive the top 60, the top 40% of the income by income drives 60% of the spending in the country. And I even looked at like net worth, like in terms of exposure to equities and mutual funds, it's really like the top 10, top 20% really get this. So we've seen this kind of this run up in stocks and everyone's doing well, but it's really I think the market going up benefits the top of the K, and then the top of the K continues spending, the economy holds up, market goes up, top of the K keeps spending. So you kind of get that loop, and you can actually kind of think. You said, okay, well, if the economy is, I'll kind of I'll edit that little loop that we did before. Instead of like, okay, well, consumer spending is driving the economy, and these consumers will spend as long as they have it, don't lose their job. Well, we can actually kind of change that a little bit. If you really think consumer spending is driven just by the top of the K, and that's more important, those people, they may not have jobs, they don't care about losing their job. Their wealth isn't tied to their income, it's tied to their financial markets. It's tied to their portfolio. So if the housing market is doing well, so it's the better way to forecast the economy maybe is to say, okay, is to forecast the stock market. If the stock market goes up, the top of the K feels more wealthy. They feel wealthy. They continue to spend. They drive most of the spending in the country. Growth goes up. markets go up. And again, so you can almost kind of tide growth there. In terms of spending, the furniture down isn't great because we kind of housing is really crucial there. But yeah, I mean, people still have money. There's a lot of liquidity. We do think this will be a big spending year. Other than that, it's the country's 250th anniversary. The World Cup is here, so we do think kind of like that will boost kind of some spending metrics later in the year as well. But no, that's a good point. I think people just have money, and Americans love spending.
We definitely love spending money. The consumer, Dom and I have been spending it for years and years and years. They have really been the driving force behind, I think, this entire economy for an extremely long time. So, Michael, moving forward, let's assume we get past this, couple of weeks, a month and a half. This thing's in a rearview mirror. Hopefully, we haven't started any more wars,
Hmm.
after that. Um, what do you look for the second half of the year, in terms of the economy, in terms of opportunities? What would make you worried, all things being equal, for the second half of the year if things come back to normal?
I guess like even before the Iran operation and oil prices spiking, we still were flagging inflation as a key risk. We'll get inflation data tomorrow. It's obviously not going to include these oil prices. So I think that's good. It'll give us a cleaner read on like whether, the trend. So we did see goods prices based on tariffs start to kind of trickle upward. We're trickling upwards. I think one thing we've been saying about we said the economy, why this part of the market or part of the market cycle kind of for some still feels a little shaky is because the economy has seemed to make a soft landing, but inflation has not made any landing yet. And people are, it's like, okay, can we get it below 2.5? Can we get it closer to 2 and get more comfortable there? So in terms of, so obviously looking into the end of the year, we expect the market pricing in some of these cuts. That's a big risk. If those get taken off the table, again, just with tariff stuff um, or with this oil stuff, or if, Kevin Warsh comes in and decides to surprise everybody as like a, big hawk. Um, so that'd be interesting. The other thing is that we've been pointed to is like fragility in the labor market. Definitely, if you want to see kind of growth pick up, we'll definitely want to see some more, broad gains there. Obviously, most of the gains have been in, healthcare and government over the past this whole cycle. But obviously, any kind of strength and more robustness in some of those numbers, I think, uh, would kind of give us more confidence looking into the end of the year. And it's just kind of, there was all these the narratives are still kind of, prescient, but it was, we had laid out all this, everybody was laying out all these different narratives for the year. And then of course this Iran thing happens and that really shakes everybody's view up. So that's what's gonna, I think, and whether you go back to that view, or not depends on how you started this question. It was kind of like, if we assume this all ends quickly, and that's right, if let's say, oil's, crude back down to 86, if it gets down to the 70s, I think that's fine. So I think that they get back down to $75. So, but again, I think it's all about the duration of this event, how long the Strait of Hormuz is going to be closed, and how long, does this turn into, just kind of like a Liberation Day event, or does this turn into some prolonged conflict that, causes everybody to throw out those January views. Um, but um, but no, I think, other than that, if these kind of, I think the rest of the world trade, the non-US trade, I think would if it would kind of bounce back. Um, if this situation kind of moves behind us. Same thing I think it's the dollar weaken again. The dollar strengthening on these events is new for this regime, and that's because the US is now a net energy producer. So the dollar is going to rise with the price of oil. Um, if that goes down, I could see kind of the dollar selling off again. So we'd be looking for some of those same trends to kind of that were ongoing at the start of the year to kind of come in and just flagging inflation as a key risk and inflation, of course, like labor market fragility. Of course, the two mandates of the Fed. What's the Fed focused on? Inflation and labor, and that's where we do think the risks lie.
So, Michael, just trying to sneak one more in
Hmm.
before we run out of time. But literally a year ago, myself and Michael, and you heard some of our opening, we're in Manhattan. We're meeting with every major financial institution, and they kept using the R word, recession, and
Hmm.
somewhere between anywhere 30, 40, one particular firm, 60% probability of recession. Anything on your radar that says there's a possibility of it happening?
The R word. I think the word we're going to see more of is the S word coming, meaning stagflation. If you've got um, growth is slowing on especially on the jobs front, weak jobs, and then inflation going higher with oil prices. That's a slow growth, high inflation scenario. I already, started seeing the word stagflation start to pop up in some newsletters, but wouldn't be surprised if this oil crisis lasts, that'll be kind of like the driving concern. And again, how does that change portfolios? Probably people shorten duration there. Curve flattens a little bit as the Fed, wouldn't be able to cut as much. So that, yeah, that's kind of how we're thinking about this. In terms of recession, same thing. Oil back at 120. Yeah, we could talk about the R word. Um, Back at 86, maybe just more inflation risk than the R word and the recession risk at this point.
So, Michael, we have to stop there, but I appreciate you giving our listeners and clients a rabbit hole to go down because now they can all Google what is stagflation.
Perfect. Slow growth, sticky inflation to keep it simple. But yes, feel free to look into it. It was a big term in the 80s, um, and was talked about a lot a couple years ago. Um, and but now I think it'll come back if oil prices stay high.
So, Michael, I know you're a busy guy. I know you're in demand. I know, there's a lot going on at New York Life, and we really, truly appreciate you making the time this evening to join us.
And the
Yeah,
timing couldn't have been more perfect. So again, thank you for making the time for us.
a lot going on. So great to be here. Enjoyed the conversation. Thanks, guys.
Thank you. So that's it for us, and we will see you next time on the Lebenthal Report. Have a good night, everybody.
Good night, all.